Good afternoon and welcome to the Victoria PLC Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it received in the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Jeff Wilding, Executive Chairman. Good afternoon to you, sir.
Good afternoon. Thank you very much for joining the call. As you will have seen from our results, the market was a lot softer in the last 12 months than it has been previously. This is largely due to inflationary pressures impacting consumer discretionary spending and a pull forward of demand when during the COVID lockdowns, a number of people understandably invested in their property and a lot of spending was conducted in that period, and consequently there has been a drop in spending in the last 18 months. This will obviously normalise over time, but in the meantime it has impacted our revenue, although I'm pleased to say that Victoria outperformed the wider market in most of its end markets. So with that, I'll hand over to Brian, Morgan, the CFO, to take you through the financial results for FY24.
Thanks, Jeff. Good afternoon, everyone. I will skip through to slide 7 as all of the slides are on our website. I will quickly run through Victoria's financial highlights of the year, which has proven to be challenging for the global flooring industry, and then I'll hand it over to Philip, who will take you through more detail on each of the divisions. So slide 7 shows the results of the group for the year. As we announced the market in March, we continue to see tough trading conditions well into the second half of the financial year, and this can be seen in volumes being lower by 12%, or roughly 28 million square metres compared with the prior year. The knock-on impact of the volume decline was revenue at 1.25 billion, being lower than FY23, with all divisions being impacted. From a margin perspective, we had differing results across the divisions. In UK and Europe soft flooring, I'm pleased to say that the results of the integration and restructuring we began in FY23 can be seen with the division showing comparable year-on-year absolute gross profit of circa 194 million and increased gross margin percentage despite an 11% decline in revenue. You will also see a reduction of 17 million in operating expenses as a result of the reorganisation, integration and other projects, delivering an improvement in absolute EBITDA to circa 83 million and EBITDA margin of 370 basis points. UK and Europe ceramics has been the hardest hit of our divisions, with volumes down 19% as a result of low demand in European and export markets, as well as increased competition from Indian manufacturers. The decline in volumes has led to a decline in profitability, and action has been taken and continues to be taken to improve profitability in this division. Moving on to Australia, this division, while seeing a downturn in volumes and revenue, continued to perform well from a margin perspective. And the North American division also showed improved EBITDA and margin after the integration of IWT in FY23. Overall, the group delivered EBITDA of 160.7 million, in line with the guidance that we issued in March. Moving on to the next slide. Here you'll see the non-underlying items, and I'll spend a little bit of time just going through some of the larger ones to explain them. We exclude these items from our underlying performance as they tend to be irregular and therefore they're distorting the trends in the business, or the technical accounting adjustments which we have to put through as a result of IFRS, but do not reflect the underlying performance of the business. There are 2 items which are cash items and the rest are non-cash. So the cash items are £1 million in relation to acquisition and disposal related costs, down from 4 million the prior year. And these are costs that we pay to advisors as we're going through the process of looking at or completing acquisitions. We also have reorganisation costs, which is a cash cost. These are through the integration of our acquisitions and mainly relate to the reorganisation of Balta. We expect over time these costs will be cash neutral as we dispose of surplus real estate from the estate that we acquired with Balta. We also took some costs through here for some redundancies in Turkey as we were managing the cost base as a result of continuing lower demand. The point to note here is that the cash flow it can be different in terms of the timing compared to when we take the accounting charge and we'll come on and look at the specific cash flow numbers in a couple of slides' time. A couple of other points to highlight here, the impairment of goodwill, and the accounting standards require us to assess goodwill on an annual basis for historical acquisitions. And to do this, we perform discounted cash flow modelling using the current trading as the base. And given where demand has been this year, and also with no imminent recovery being forecast in our models, this has resulted in an impairment which we've taken this year, mainly in relation to our Spanish and Turkey ceramics businesses and our Cali business in North America. So moving on to the next slide, cash generation. And you'll see here that operating cash flow before interest, tax, and exceptional items is 106.4 million compared to 157.8 in FY23. For the full year, we've seen an outflow in working capital of 15.2 million, and this is made up of an outflow in the first half of 27.6, when poor demand was not aligned with our production and inventory levels. And in the second half, the business took action to reduce the inventory levels, which released cash from inventory, resulting in an inflow of 12.4 million. We expect to see this inflow continue in FY25. Other points to note on the slide are capital expenditure, where we now see this returning to normal levels, having had a significant outflow in FY23 of close to 100 million, with a lot of that in relation to the reorganization of Balta when we bought it by moving production out of Belgium and into the UK and into Turkey. The surplus real estate asset disposal proceeds, this is in relation to the property that we sold in Belgium at the end of the last calendar year. And exceptional cash items, you'll see here that we had 29.3 million outflow in FY23 and an outflow of 33 million in FY24. These relate to the accounting charges on the prior slide, and we expect in cash terms to pay out roughly 11 million in FY25. If we look on to the next slide, we've got a graphical representation of the movements in net debt. You'll see that net debt has decreased from 658.3 million to 632.9 million. And the building blocks for that are across the page, with the free cash flow from before exceptional items 28.2. We also had the net impact of the reorganization costs in Balta of 23.2, and this is after you net off the proceeds from the disposal of properties. The 15.8 relates to earn-outs payments that we've made on prior year acquisitions, and that number will become smaller in future years. Also, we had an inflow from further utilization of factoring, which is not included in the definition of a net debt for this purpose. And also, we've had a benefit of 22 million on the retranslation of our euro-denominated debt. Finally, for me, moving on to the last slide and looking at the net debt structure and also the leverage. The leverage this year has increased from 3.4 to 4.4, despite our net debt, which is used for measuring leverage, decreasing. And this is purely as a result of EBITDA being lower this year than it was last year. Management is committing to reducing this leverage ahead of the next round of refinancing by generating cash from operations and the sale of non-core assets. And this includes further disposal of real estate in the Belgian portfolio. We're expecting, we've already completed one, and we expect to complete another in the later stages of this year. You'll also see from this slide that we had 73 million of cash at the end of the year, and also with the lower senior secured debt, partly due to the bond buyback and lower drawdown of facilities elsewhere. We have a liquidity position of over 250 million across the group. All our senior debt is long tenured, with the earliest repayments needing to be in August 2026. And with that, I'll hand you over to Philip.
Thank you, Brian, and good afternoon, everybody. So when being faced with the market challenges last year, management has been focusing on the completion of the integration and the right sizing of different projects, as we have described in the previous published reports. We believe that all of these actions, which have led to a reduction of about 1,200 FTEs, which is about 16% of the total workforce of the Victoria Group, will deliver structural improvements in the company's operating margins. due to lower capex, also a more competitive position due to the right-sizing projects which we've conducted, a better consumer service level given the investments which we've conducted in our DCs in the UK and the US, a lower cost of manufacturing, and working capital reduction exercises in terms of SKU and a better supply chain. This can already clearly be demonstrated in what happened in our first reported division, which is the UK and Europe soft flooring, where we have seen a vast margin expansion and a strong outperformance of the wider market. Yeah. Albeit that revenue and output were down around 11%, which is much better than UK volume drop, which we expect last year has been about 20%. The 11% drop is against a 31% like-for-like growth in the previous year. The margin or underlying EBITDA improved from 23.8 to 67 million, from 67 million pound to 83 million pound, which is a vast improvement of 370 basis points. So what has happened on operational level? The broadloom manufacturing in Malta, Belgium has been stopped and the production has been transferred to the UK factories in South Wales and Yorkshire. This has provided even better cost absorption due to the increased volumes. And moreover, when extra capacity is needed, we can order these quantities externally with third-party manufacturers, which we have lined up in Turkey. The Malta revenue has also been screened thoroughly, and a lot of bottom slicing has happened, whereby non-profitable revenue has been ditched to the benefit of the working capital. Also, simultaneously, in what we call our Super DC and Super Distribution Center in Worcester, which is also our headquarters, this has been brought to life last year. So our 4 Alliance UK distribution centers have delivered 780,000 order lines last year, with a 99.2% on time in full delivery and 98.7% within 3 days. We've also acquired the first electric vehicles, through which we deliver now 25% from the manufacturing plant to the distribution centers carbon-free. I would also like to remind you that the logistics operation, for people who have not followed that in the previous years, that our logistics operation is a unique differentiating factor for our service which we are offering to the UK. In rugs, the operational plan has been rolled out, whereby we have closed 1.2 million square feet plant and transferred the equipment to one of our 2 Turkish manufacturing plants for improved cost efficiency. And in the meantime, the Belgian plant has been sold, which has resulted in a 32 million euro net cash inflow in FY24. The next division, which we are reporting, is the UK and Europe ceramic tiles division. Following a double-digit like-for-like revenue and EBITDA growth in FY23, the key metrics returned to the FY22 levels in FY24. The main reasons for the significant drop are the volume declines which we've seen in the key markets, being France, Germany, Spain, and Italy. We have also decided to hold pricing levels in the face of a weak demand to protect premium brands. Brand equity is important to us, and especially with the brands which we are having in Spain and Italy. We've also seen, and that's the third reason, the sudden and aggressive pricing competition from ceramics manufacturers in India. However, in April this year, anti-dumping and countervailing duty, so anti-subsidy petitions, were filed by the industry with the US government, seeking to impose substantial tariffs. And the same is to be expected in Europe anytime soon. Of course, this revenue drop, which is over 20% in volume and value, has had a severe impact on production variances. As you can imagine, there was a lesser cost absorption. So mitigating actions have been taken, and which are still in the process of being taken, which is the full integration of all production sites in the 3 geographies, which is Spain, Italy, and Turkey, to optimize the efficiency. Specific sizes are being allocated to specific factories, to specific kilns, There's also been investment in new technologies such as printers and packaging lines to bring the Turkish production up to European and US standards going forward. We've also entered into conversations with customers to discuss value engineering to the benefit of the cost of goods sold. And then thirdly, Saloni, which is our commercial brand, has been completely revamped, and new showrooms have been opened in Spain and elsewhere in Europe, which are more focused then on the A&D, so the architects and designers community. So very quickly on the two remaining reported divisions. North America, I just want to remind you that in North America, we're only distributing, we're not manufacturing. Our largest distribution business is Cali in San Diego, California, mainly offering luxury vinyl tire as an omni-channel distributor through the Charleston, DC, followed by the two Balta warehouses, which we have in Rome and in Savannah, and the IWT warehouse, which we have in Florida. So the US has always been, for as long as we're there, proved to be a resilient market for Victoria, and the volumes have been up, but revenue was down with about 3%, which is about £2.5 million. So last reported division is Australia. Traditionally very stable margin and a somewhat softer marketplace, as we can see in the very start, also in the new financial year. Following the double-digit organic growth in FY23, demand in Australia was slightly softer across all flooring divisions, about 4%. And the revenue fell a bit more, with about 12%, but this was mainly due to product mix. Just a reminder, in Australia, we have two carpet plants in Melbourne, and we have a distributor in Sydney/Melbourne, manufacturer distributor of underlay and LVT. There has been, in the meantime, no structural change in the Australian market, and we expect demand in Australia to recover due to the onwards or inwards migration and the overall drop of the interest rates, which we expect to happen later in this year. Maybe a couple of words on the outlook, Brian.
Thanks, Philip. Before we move on to that, I'd just like to raise the points around the audit this year and last year. So you will remember that there was a qualification in the FY23 audit in relation to a small subsidiary, which is less than 20 million of revenue. And this was due to the fact that there were incomplete accounting records, concerns around the control environment. And the board limited Grant Thornton's scope of audit in relation to solely that subsidiary, which was what the qualification was in relation to. We lifted that limitation after the accounts were signed last year, and Grant Thornton have been in there doing work since that until the end of the audit at the start of this week, as has my team. I'm pleased to say that Grant Thornton were able to satisfy all the concerns that they had in relation to those early years of the business. And we now have a clean audit report for both this year and last year, as will be seen in the annual report, which will be published in the next couple of weeks.
Okay, a couple of words on the outlook. When analyzing the key indicators for the outlook for FY25, we do see construction PMI back just over 50, which is suggesting the initial stage of growth. Consumer confidence also has improved from a very low end 22 and early 23 to a much better current level, albeit, as you can see, there's still a way to go there. Mortgage approvals in the UK have increased substantial, and we should see the sales of homes following the same trend anytime soon. The next slide is listing the upward synergy potential. But okay, we've gone through that when talking through the division. So just short repeat: integration of Balta in Broadloom and in Rugs. So project in Broadloom completely finished, in Rugs in the process of happening still, but which should come to the end in the next 3 to 4 months. Integration of Graniser in ceramics, that's the investment we've done to come more up to speed and have a better kind of product for delivery in Europe and in the US. And then the integration of Cali flooring, which will be using the partially the Balta, but in general the Victoria distribution centers to the benefit of the supply chain. Brian?
Thank you, Philip. And just to finish off, just talking about our cash generation and our balance sheets. We are conscious the leverage has come up as a result of the performance this year. We're working on a number of different things, to improve performance and also around self-help in terms of our balance sheets. And what you see from the slide is we're looking to the exceptional costs will reduce as we've completed the large reorganization of Balta. We're also now returning to a more normal level of CapEx, as I mentioned earlier on. Working capital, the team has been and continues to work on reducing working capital, and we're looking to squeeze more out of that in the coming year. We've also looked at our real estate across the group where we have surplus properties, and we're looking to raise over 50 million in FY25 in relation to that. We have one property which is pretty advanced in the process, and we expect that will complete in this calendar year. And as you can see, in terms of capital allocation, the focus for us will be the three items, but predominantly the priority will be in reducing leverage. It's also worth noting that the bond, the first tranche of the bond, is not due till August 26, but we are starting the process now to make sure that we are ready to refinance that when the market is optimal for us to do that. We talked about the last presentation around our leverage targets, and while in the past we were happy with the higher leverage, there were a number of reasons for us to want to get to a lower leverage. And the right-hand side of the slide talks about how we're going to go about doing that by both helping out in the numerator and the denominator. So with that, I think the formal part of the presentation is complete, and we're happy to take questions.
Perfect, Jeff, Philippe, Brian, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions that are being submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation, and if I could just hand back to you to read out the questions and give responses where it's appropriate to do so, I'll pick up from you at the end.
Yeah. Right. Thank you. There's been several questions received about the repurchase of the senior notes, which we were undertaking earlier this year, and whether we intend to continue with that. We have a stated policy, which you will have seen both in the presentation and also in the market announcement yesterday, that it's our intention to reduce leverage, and clearly one of the options available to us to do that is to continue to repurchase the senior notes. So although we cannot be explicit about what we're undertaking or not undertaking in the market at any given point in time, that I just want to reiterate that it is our intention to reduce leverage. So again, there's a couple of questions around appointing financial advisors to assist with the refinancing. No, we haven't appointed any financial advisor at this point in time. We're still gathering our thoughts very clearly in terms of the corporate activity of the business. The focus in the last or recent months has been on ensuring we get an unqualified audit for FY24, plus ensuring that the audit for FY23 was revisited and also given us a clean audit for that year. So the focus has been there. We will continue to gather our thoughts over the weeks ahead and make a decision in due course about financial advisors and how we approach the refi of the bonds. So also, we just on Balta and the reorganisation, we've been talking about this the reorganisation since for about 18 months now, and I just wanted to highlight, given a couple of the questions, that despite much softer demand, with our revenue down 11% in the market, down more like 20% in our soft flooring market, our EBITDA improved and our gross margin improved by some 17 million, despite the drop in revenue, which points to the success of the reorganization and the cost that's been taken out of the business. Mathematically, if our revenue returned to FY23 levels, EBITDA for the soft flooring division would be over 100 million. And I think that's a credit to the operating team at Victoria and augurs well for the reorganization that's currently being undertaken in the ceramics division. You'll note that, again, given the soft market, the only division which had materially negative results this year was the ceramics division. The other divisions were either neutral or positive. And so I think you can take some comfort from the fact that the operational team has track record now in reorganizing, and I think you can expect to see some better results out of the ceramics division this coming year. Sorry, we're just taking a moment to read the questions that are coming in. So, do you want to talk about the anti-dumping?
Yeah, well, this is in the process of happening. We don't have a final decision yet. So, yeah, maybe the question is there any more comments on the anti-dumping petition regarding the ceramic tiles filed in the US? So this is in the process of happening. The petitions have been sent, and the US government will take any measure anytime soon, which will probably have a retroactive character of a few quarters. So,
just picking up, also we expect the industry's expectation, including ours, is that the petition will be successful in the US and that Europe will follow the lead of the US. If we start there.
Well, there's a question on competitive positioning in key markets, Europe, North America, UK. So all is to do with product development and service. So we're not in the bottom end of the segment. It's good to remind everybody here that that we are more in the medium to high end of the market, where service is extremely important. So enhancing our competitive position is just always be in the forefront of service, adding extra elements of service throughout the whole offer. And this is what we're basically doing mainly in our largest markets, which is the US, and so the UK and the US.
I think that's it for questions, unless there's any more.
Perfect. Jeff, Philippe, Brian, thank you very much for answering those questions you can from investors. And of course, the company can review all the questions submitted today, and we'll publish those responses on the Investor Meet Company platform. But perhaps just before redirecting investors to provide you with their feedback, which is particularly important to the company, Jeff, could I just ask you for a few closing comments?
So I think the three messages I'd like people to take away is, firstly, and obviously very importantly, the company received a unqualified audit for this year, and the audit decision of the audit outcome of last year has been reversed. So we now have 2 years of clean audits, which is what we should have, and we expect to have that going forward as well. So I think that's very important to stress that the entire company now has a clean audit opinion. The second issue is that, or the second point I would like to make that we could talk about briefly, is there is nothing secular, or in other words, nothing structural that has changed about the sector. People will still require flooring. There's obviously some sort of an impact on consumer discretionary spending over the last 18 months, 2 years, with higher interest rates and high inflation. As that mitigates or moderates over the months ahead, we do expect flooring demand to recover, and the company now has much lower operating costs. It has higher gross margins, and as demand recovers, we expect a very sharp recovery in both earnings and cash flow. To give you some idea, the volume of flooring sold today is down some 20% from what it was. The volume of flooring sold in 2023, calendar 23, was down some 20% on the volume sold in, this is by the industry more widely, in calendar 2019. So that is not an exceptional year. It is a perfectly ordinary year, but demand is now currently 20% lower below that. So that implies that just to return to normal demand levels in terms of volume, would require a 25% uplift in volumes from where we sit today, and each 5% is worth about 25 million of earnings to Victoria. So as demand recovers, we're expecting a very sharp improvement in both earnings and cash flow. And that ends the presentation to shareholders today.
Perfect. Could I just thank you all for updating investors today? Please could I ask investors not to close the session, as you now be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. This will then take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Victoria PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.